April was a weak month for share markets globally, with the main global index, the S&P 500 index, down 9% for the month, with the Nasdaq down even more. Australia had a relatively good month, but still fell 0.8%. And very pleasingly, investors' mutual funds did far better than their various benchmarks, with the major fund, the Australian Share Fund, up 1.5%. And we are seeing a return to quality and value type investing and a less speculative tilt to the market than we had seen for some years. If we look at what was good and bad in the portfolios, we were hurt by our media holdings. Things like Nine Entertainment and News Corp were down, partly, I suppose, because they are viewed as media companies and the Nasdaq's full of media companies and so forth. But also there was a warning late in the month, not even a warning, but Netflix reported a loss of subscribers, and that was taken very badly by the US market. On the plus side, a large number of our industrial stocks, key positions for the fund, did very well, such as Amcor, Horizon, Brambles and Metcash, to name a few. As we look forward, the Reserve Bank has finally raised interest rates. Inflation is starting to become rather entrenched, both here and globally. And so it is very likely that the Reserve Bank has acted too late to really contain inflation. As I wrote in the Australian earlier in the month, that we are seeing very high house prices in Australia, high house prices to income, a lot of debt, a lot of leverage, and the higher interest rates will probably crimp consumer spending and consumer demand. And so we could see tougher times ahead for the Australian economy. Lower house prices would be good for the inequality that's arisen from the divide in house prices, but it may not be so good for the average company. And at such times, we do believe that quality defensive companies, such as the ones we own, will do much better than the market.